Hi everyone, thanks for clicking on the video. Today I'm going to go over how to build this 3-year financial forecast in Excel. And this is the summary tab. I'm going to go through the rest of these tabs, but before I do that, go ahead and go to the subscribe button down in the right hand corner. Subscribe to the channel so you can check out the rest of these videos that I have available. And while you're at it, go ahead to the AccountingExL store. Check out what we have available. If you are an accountant or a small business owner, it's really going to help you out, and all the links are in the description. Alright, let's go ahead and get started here. So I just want to give you a quick overview of the file. So the file has a couple different tabs here. It's got a summary tab, which has the balance sheet, has a summary income statement, and a summary statement of cash flows. But then it also has a full balance sheet tab, a full income statement tab, and a full statement of cash flows tab. And with each one of these, you can drill down into the quarters or into the years. So it's really convenient if you want to analyze by quarter or by year. You can just drill down as deep as you want to drill down and then expand it back out to the month. So then it has an assumptions tab, and on the assumptions tab, this is where you're going to list out all of your assumptions that you use to build the forecast. It's got a couple of other things here that I'll go over in a couple minutes. And then it has a sales forecast, which is kind of the beginning of everything, where you're going to enter most of your information. And then it has an expense forecast, where you're going to enter most of your expense information. And then it has a list tab, and the list tab just has some general information that we use to kind of set up the file. So to set up the file, what you want to start with is just entering your company name to begin with. So for this example, we're just going to say it's going to be called Consulting Business or Consulting Biz. Okay, so then I just fill it in there in the first tab, and then it's going to populate the rest of my file for me. And just real quick, I want to show you how quickly this can go. I'm just going to enter a transaction and kind of show you how everything all rolls up. So to do that, I'm just going to enter in a sales transaction. So for customer name, we're just going to go B and B stays. The project name is going to be, I'll just say project 1. And then the contract value is going to be $36,000. And the stage is in the 1 stage. I'm going to select that. Then you can kind of see here where it's given an 100% probability, and I'll go over that in a second here. And then the amount that it's going to allocate is $36,000. And if you want to put in a sales rep, we'll just put in my initials for now. And then contract start date, we're going to put in 1/1/20, and contract end date's 12/31/22. So then it automatically populates all of your revenue for the entire contract. So that's what's really nice about it. And then what this does is it's going to populate the rest of your file. So it comes and it populates your income statement. It populates your balance sheet, and it populates your summary tab with all the information they entered. And the same thing that happens with the expense forecast. You enter something in here and it's going to populate everything. So I wanted to show you that just so you can kind of see how the file is going to work before we get into the example. But I'm going to enter a lot of information in here. We're going to build an entire forecast. So let's go ahead and start setting that up. Okay, so real quick, I'm just going to delete that entry that I already put in there. I'm just going to delete so we don't have it in there while we're setting everything up. Then I'm going to come to the summary tab, and the first thing that I did was just put my business name up here in cell A1 on the summary tab, and then that populated the rest of everything else with the company name. Second thing you want to do is you want to select your start date. So this is going to be the date that you want your financial forecast to start. So it's going to start in January, and you can select whatever year you want your forecast to start. So say that we wanted 2019, select January 1st, 2019. It's going to populate all of your headings for the correct dates and all the way through the file based on what's selected here. So we're just going to keep it at 2020 for this example. The next thing that you want to do is think about your accounts receivable terms for your company. So a lot of companies, they collect right up front. Some of them collect, net 15, net 30, net 45, net 60. So you want to kind of think about when your accounts receivable gets collected, because what you want to do is set up your assumptions, because this is going to affect your accounts receivable balance. So you kind of need to put some percentages in here. Okay, so for this example, I've looked at the history of what our AR collections typically are. I've come up with some percentages. So I'm just going to go ahead and put those in here. So we usually collect within about 60% of our AR within 30 days, about 20% within 60 days, another 15% within 120 or within 90 days, and then 5% within 120 days. So once you've done that, the next step that I would do is kind of look at your assumptions. What kind of questions do you have? What kind of revenue questions do you have? What kind of expense questions do you have? What are your assumptions going into how you're going to build your forecast? Typically, you want to start with your revenue forecast. So I've kind of thought through this in advance, and to save some time with the video, I'm just going to go ahead and copy and paste some of my assumptions in there and then kind of go through them. Okay, so these are kind of my assumptions here. We're going to grow the company from a $100,000 company to a $1 million company by the end of 2020. We're going to have to close $2.3 million in sales over the next year through a mix of different services that we provide. We're going to ramp up sales on our proprietary property. This gives us more revenue. Kind of going through some of our expenses. This is kind of a consulting company where we hire CFOs, and we have a back office accountant and some accounts receivable and accounts payable type people that we provide this service for. So these are kind of the different costs associated with hiring those people. And then just some assumptions of how many we're going to need to hire, what they're going to get paid, what our office rent is, what our accounts receivable policy is, what our accounts payable looks like, the debt, if we need to get a line of credit or use credit cards or anything like that, that's going to go in here. And then with equity, what the owners are going to have to contribute, and then what kind of cash balance you want to maintain, anything else gets distributed, stuff like that. That would all go in your assumptions there to build your forecast. So like I said, I already thought these through. I kind of already have them, but you want to do this on your own and just kind of go through your business and really think about that kind of stuff. Okay, so the next thing that you want to do is you have this prior month's revenue over here. So what this is our forecast is starting on January 1st, 2020. So what we need to do to calculate our accounts receivable collections properly, we got to kind of go back in history and look at what we received or what our revenue was for December, November, and October, so that we can calculate our accounts receivable on that revenue that we earned. So I've kind of already done this, so I'm just going to go ahead and enter in some numbers that I have just as an example. So these were my revenue numbers for the last 3 months before this schedule started. So once we have that in there, you're gonna see that populate on the balance sheet. It's gonna show this is what your accounts receivable balance is based on what we just entered for those next 3 months. Okay. So now we basically have the file set up. The last thing that we need to do is enter in our beginning balance sheet, and this kind of has to be entered for the file to work, because everything's based off of your beginning balance sheet numbers to project out the rest of your balance sheet. So I'm going to go ahead and enter those numbers in. So we got cash and cash equivalents of $229, accounts receivable of $2,419, and then we're going to have other assets, other current assets, and that's going to be $3,545. Okay. And then down here in our current liabilities, we don't have any accounts payable, but we do have some credit card debt. And that's going to be $4,539. And then we have a small liability, we'll just call this other current liabilities. That's going to be $10. All right. So we also have a loan, so we're going to put that in here, just a small loan payable, $4,651, and then we have some retained earnings, negative actually, so accumulated loss of $3,007. Okay, so our balance sheet, and here's a little check to make sure that it's balanced. Our balance sheet is all set up with our current balance sheet. So just one thing I want to show you real quick. This balance sheet kind of comes over and integrates with this statement of cash flows here. So anything updated on the balance sheet is going to flow through to this statement of cash flows. So that your statement of cash flows will populate correctly. So if we want to change some account on this, we just have to update the balance sheet. Okay, so the next part of this is just to start to populate our sales forecast. Before I get into that, what I want to do is show you what these what this probability is. Sometimes, whenever you're doing a forecast, you make certain assumptions about, if an opportunity is in a certain stage, maybe you have assigned it a certain percentage of probability, so that way it doesn't calculate the entire projected contract. Maybe you only want to calculate 80% of that or something like that. So to do that, you kind of look at the sales stages over here on the list tab, and there's got different stages, and you can update these to whatever your company has. I just put in some standard ones that I have seen before, so prospect, discovery, proposed, committed. So you just change your percentage. So say that you wanted to say committed was only 80% and proposed was 85%. You could do that there, and then whenever you select your stage, proposed, it's going to put in 85% there. So that's all that does. For this example, we're just going to use 100% for everything, because we've got a really good beat on, where our sales stand. So, and we don't have very many of them, so they're kind of easy to keep track of. So we're just going to keep everything 100%. So let's just go back to the sales forecast. We'll start entering in our information here, and I'll enter a couple of them in just so you can see how the forecast flows through, and then I'll go ahead and copy and paste some other ones in there. So like before, I had B&B stays, and we'll just call it project 1, and contract value was $36,000. The stage that we're in was 1, so it's going to allocate $36,000 across your revenue. And then your sales rep, I'm just going to put some initials in here. Contract start date was 1/1/2020. Contract end date was 12/31/22. going to calculate the rest of that all the way through for the rest of the contract period, and then it's going to update our income statement, update our balance sheet for that transaction. So you can see it's really easy. If you just enter in all of your information here, it basically creates the forecast for you. So this is kind of, we have a little side thing where we make some sales here and there. Project name, we'll just say product sales. That's in the one stage. And for that, it's just going to be year one. So we're going to put in 1, 20, 12, 31, 20. So you can see there, it's not going to calculate past the first year because this date doesn't go past the first year. That's kind of how it works. Even if you were to put something in the middle of the month, it'll calculate just the number of days. So if you put in something for the 16th, of June, it's going to calculate basically half the month of June, starting in June, and then calculate the rest of the contract based on the number of days. So I'll put in one more so you can see kind of how it works. Red flame fire sprinklers. Project 2, and that's going to be 54,000. Select one, and the date on that again is 1/1/20, 12/31/22. Okay. So what I'm going to do now is just kind of copy and paste in the rest of these transactions that I have. But you can see now that it's calculating $2,522 for January 2020. Come to our income statement, $2,523. And then that all rolls through to the balance sheet and the statement of cash flows. And then ultimately to the summary. Our cash up here, $64,432. Cash down here, $64,432. So I'm just going to copy and paste in the rest of these guys real quick. Okay, see how it populates there. And put in our sales rep, put in our dates. So now you can kind of see how it really works, because this one, for instance, starts on 4/15/2021, so you're not going to see anything until April 2021. It's about half because it started halfway through the month, and then goes through the rest of the contract period. So that's kind of how the sales tab works. Next, we're just going to look at the expense forecast real quick. So works in the same kind of way. It's a little bit different though, because we're calculating our monthly frequency. So we can have, it's going to be a monthly expense, or it's going to be a one-time expense. So you're just going to be able to select that right there. So same kind of thing. I'll enter a couple. So we'll start with office rent. $450 per month. It's going to be monthly. Our classification here is going to be either cost of goods sold or SG&A. So you need to kind of think those expenses through, what you think it's going to be. So for this, SG&A, start date's 1/1/20, end date is 12/31/22. So you can see it's going to calculate that $450 every single month until that end date. Same as the sales, except the frequency is monthly. Instead of with the sales, it was the whole contract period. Next thing, we're just going to put in, let's see, website, domain, registration, and it's $12.50 a month. That's SG&A, and same thing, 120, 12, 31, 22. So it calculates it again. So I'm just going to go ahead and let me just show you how it flows through here. So we have SG&A expense. Right here's our rent. Right here's our website domain, all right here. So I'm going to go ahead and copy and paste in the rest of those real quick. Copy in our amounts. It'll populate everything for us. So you can see right here on the one-time expense, when you select one time, it's just going to put it in that month. And you don't have to put in anything on the end date for one-time expenses. It's just going to put it in right there. But if you were to change it to monthly, you'd want to put in the end date. So now you can see everything up here is populated, cost of goods sold and SG&A. It sums up everything based on what you select here, and then it rolls forward to your income statement right here, populates cost of revenue every month and SG&A every month. And that rolls up to your balance sheet, rolls up to your summary. And this is always a good check to look at. Just make sure your ending cash here is the same as your ending cash here, and then you know everything's working right. All right, so let's go back to our assumptions real quick. And part of our assumptions was on this consulting company that we were going to issue, the company will need a $350,000 line of credit to cover sales and expenses until revenues and profits can sustain the business. We'll pay off the debt as soon as possible, and then with the equity, the owners will contribute $10,000 each to cover initial costs and salaries. And then we're going to maintain a balance of $300 once it's accumulated, and any additional balances are going to be distributed to the owners on a monthly basis. So let's go see what this looks like. All right, so we've entered in our sales, entered in our expenses. There's a couple balance sheet items here that we kind of need to take care of, and we're going to take care of those directly on the balance sheet. So the owners are going to contribute $10,000 each. Let's assume there's two owners, and we want to contribute that in the month of February. So we're just going to come here, put in contributions, $20,000, and we're just going to maintain that balance for the rest of the time, the rest of the forecast. A little shortcut here, just Control-C, Control-V. You can see while I'm doing this that the rest of the balance sheet is updating. That's because this has an effect on the amount of cash that we have. So right now you can see it's negative, and that's why we're going to need the line of credit. Go ahead and paste this all the way through. Okay, so we have our contribution in there of $20,000. The next thing that we're going to need is we're going to need to add our line of credit. So we're just going to put our line of credit right in here, line of credit, and that is going to be $350,000. Okay, so I'm just going to leave that there for now, but I think we're going to need to extend that the rest of the way out here because looking at our cash balance. But real quick, something I need to come back to is we have these these balances that are already here as of our year end. Okay, so we're gonna have to do something with these. We gotta make some assumptions, all right? Right now we don't have much cash, so we're probably not gonna be paying off a lot of debt. So let's go ahead and put this in there until we think we can pay it off. Just gonna copy and paste it in here. All right, that might be long enough. And then we also have this credit card debt, and we have this other liability here. So same thing. We're just gonna leave this here until we think we can actually pay these things off. Okay, credit card, same thing. You know, we have a monthly credit card payment that we have to pay, so I'm thinking we're gonna be making payments of about $50 a month on this until we get enough cash to be able to pay this off. So I'm just gonna go with $4,500 here, $4,450, $4,400, $4,350, $4,250, $4,000. And we'll see what happens here. Okay, so now let's see what our line of credit has the effect of here. So put in our line of credit. All right, so it's looking like if we just maintain this line of credit, we're gonna have some cash in the bank. So maybe what I want to do is get rid of this $10 for sure. Okay, it looks like we were able to pay off the $4,000 with no problem. Still got cash in the bank up here in July. And we still have a negative cash balance, so we're going to go ahead and keep that $350. All the way through until we start getting some cash in the bank from our income. So we're getting there, we're getting close. Alright, so looks like for the first time we made it above $350 in cash, so that's a good sign. I'll go ahead and go here. Alright, so maybe we want to start paying some of this off because our goal is to pay off our debt as soon as we possibly can. So maybe starting in March, we pay off 40,000 of it. So we'll go 310. Still got cash in the bank. 310. We'll go 270. 250. 215. 175. So we're maintaining that $300,000 in the bank as we pay this off. 150, 125, 75. Oh, not 75,000. 50, 15. Okay. So that looks pretty good. So now we are, we got some positive cash here. And one thing that we have to kind of take into consideration here is that we have a line of credit, so we're going to have some interest expense. And then we also have some interest expense on the credit card. So calculate some interest expense. There's a place for interest expense right here on the income statement. And I'm just going to expand this real quick. And we're just going to put a little formula in here that calculates our interest expense. So we're going to go with equals balance sheet. We're going to select the credit card, the prior month's credit card balance. Okay. And then we're going to multiply that by our interest rate. So let's just, for this purpose, we're just going to say that it's 22% on a credit card. And then we're going to divide that by 12 months. Okay. Then we're going to add our interest from our line of credit. So plus line of credit right there. Right now it's 0, but it's gonna have a balance on there. Times, let's just go with 8% for this. Okay, so we got our interest calculated, and then what we need to do now is just copy and paste it to the rest of the income statement. Okay, we got it. So it looks like we have everything. And everything's balanced. Let's come to the summary. Check it out. Our cash matches up here, the cash down here. Everything looks like it's flowing through correctly. Alright, everything looks good. So we're just going to go ahead and hide some of these areas with zeros. And the depreciation expense. There we go. So now this is all set. You ever wanted to put together a business plan or something like that, and you needed to present these financials, you just take the summary tab and copy this and put it into your document. Same thing here. I'm just going to get rid of some, hide some of these, so it makes it look nice. And that's how you do the financial forecast. I like to think that took us less than an hour to do a 3-year financial forecast. So if you think this video was helpful, subscribe to the channel, check out the links in the description, download the financial forecast. This is for a services-based company. I also have a video and a file for a product-based company. I'll leave a link in the description to that. And we'll see y'all next time.